Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community.
I'm Nathan Stovall, and on this episode, we're talking about the liquidity crunch that has recently played out at Silvergate Bank and what takeaways that the industry and possibly even the regulatory community could have from the severe actions that the institution had to take after facing billions in deposit outflows in a relatively short period. Joining me on the show to talk about that is Todd Baker, a senior fellow at the Richman Center for Business, Law, and Public Policy at Columbia Business School and Columbia Law School. Todd, thanks for coming on the show.
It's a pleasure, Nathan.
Todd, let's start off a little bit with kind of what got us here. We saw Silvergate face really a historic run, maybe not so much in terms of dollar values, but when you look at the amount of cash that flew out of the bank in Q4, where they lost billions of deposits in the aftermath of the FTX fall. And that required them to basically purge their bond portfolio to cover the liquidity shortfall. And they took a pretty big loss in the process. And that was sort of the worst case scenario that investors had feared for kind of a lot of the industry as the industry could face outflows. And their situation is obviously a little unique. We saw further liquidity strains in the last month and ultimately culminated with them announcing plans to voluntarily liquidate their operations. How do you look at the, call it, bank run that they faced? And do you see any difference in what they faced more recently versus maybe Q4, or just really sort of a continuation of a trend that kind of is natural when any bank kind of faces this liquidity pressure?
To answer your last question, I think what happened in the first quarter was really just a continuation of what they faced in the second half of last year, and very particularly in the fourth quarter. And what happened, as you know, was kind of a correlated liquidity crunch, correlated with a reduction in the value of their securities portfolio. So they are an unusual bank because they were 100% crypto focused. They had eliminated over time all the other businesses that bank had once been in, commercial lending, mortgage lending, etc. And basically their only business was what they called the Silvergate exchange network, which was a way of settling dollar balances between big players in the crypto business, crypto whales, crypto exchanges, big institutional investors. And what they did is they put deposits in Silvergate Bank, and then 24/7 Silvergate was able to essentially settle dollar balances between the two, a little bit like what the Fed does every night between banks, except they were doing it in real time, so it was a 24/7 settlement problem. And that, worked okay. Silvergate had, I forget what the total number was at the height, but, maybe 15 or 20 billion in deposits from these crypto players. Silvergate thought there might be some volatility in those deposits. And so the rest of its balance sheet was largely investment securities of relatively short tenor and government guaranteed. So it was treasury securities, mortgage backs, maybe some municipal securities. And Silvergate thought that it would be able to handle any volatility in the deposit portfolio by liquidating securities or possibly pledging some to the federal home loan banks. But what happened is something that happens when banks are dealing with a new industry, in this case crypto trading, that didn't have a long track record and had never really been stressed, and in particular had never been stressed by rising interest rates. And so rising interest rates had two effects on crypto trading, on those people who were putting in the big deposits. One of which was that essentially as crypto trading grew up in a period where you could not earn any interest on deposits or other safe assets. And as soon as alternatives that provided yield, like banks are currently offering, close to 4% on some deposits, it made crypto trading less attractive as a business. It also made leaving $15 or $20 billion in a non-interest bearing deposit account at Silvergate Bank a lot less attractive, right? Because you're essentially losing at 4% every time you leave that money in there. So the result was balances start to decline pretty rapidly at Silvergate Exchange Network. This was made much worse by the whole FTX mess, which, significantly degraded activity in the crypto trading business. So the deposits were coming out. And at the same time, the Fed kept raising interest rates. And so the securities that Silvergate had on its balance sheet became underwater. And in order to sell them or liquidate them in order to pay off deposits, they had to take losses. And they took enormous losses through the fourth quarter. As this, combination of events was occurring, they probably thought that the Fed was going to stop raising interest rates and they might make it through. They burned half their capital, but, we're still technically in compliance. But then the first quarter just got worse. And, basically across the range of rates that are relevant to the securities portfolio, there was about a 50 basis points increase, which meant that the prices went down substantially. And so as this happened, they had to keep liquidating securities at a loss. They had to pay off the Federal Home Loan Bank advances they'd taken as a liquidity measure in the fourth quarter at a loss. It just sort of spiraled. And then once the world knew what was going on there, there was even more pressure to withdraw deposits. So basically, they suffered, as you mentioned, a deposit run effectively.
Yeah, and just building on top of that too, even sort of beyond the bond portfolio being underwater, they really hadn't had much in the way of interest-bearing funds prior to sort of that initial run. They started to build them in Q3 and then build even more. And if you look at the cost of those things, they were 2x on what the industry was at the time. They were basically having to pay up in a huge way.
Right. And they one of the things they did for liquidity in the fourth quarter is they put on, I think, $2 billion or thereabouts of broker deposits at a very high rate. And they borrowed from the Federal Home Loan Bank at presumably a reasonably high rate. And so, that put further pressure on their core profitability, which wasn't that great to start with. And they had this Bitcoin loan portfolio, which yielded some, but basically that was their only interest earning asset situation. And once all their securities became available for sale, it was, fairly transparent as to what the loss they were looking at was, and they just weren't able to find an alternative. And as a result, they're liquidating, saving the FDIC the trouble of taking them down.
And when I look at it, it's a very unusual situation. No one is 100% crypto like they are, and that's good for the banking system given what's played out. But some of these things, we've seen pieces of kind of play out across the industry, albeit a much, much, much smaller form. But just picking up on one, the idea of broker deposits, we know since the liquidity coverage ratio first came out, regulators have long assigned higher outflow rates to those things in a stress scenario. So some of this, it's like, this is what happens in the face of if there's kind of like a loss of confidence. Do you think, I know you've been critical of crypto, so maybe sort of pushing that aside, but do you think
Sure.
that there's kind of any read-through from this situation in terms of lessons learned, maybe from like an asset liability management standpoint?
Well, for sure. And, what happened here, crypto is crypto volatility in the business is the cause, but it's really no different from a situation you might have had in the 1980s or 90s with, an oil patch lender that was over concentrated in oil and gas exploration, or you can think of other examples. It's just a bad idea for a bank to be completely concentrated in one industry. It never works from a risk management standpoint. And it's also bad for a bank to be heavily concentrated in a business that hasn't seasoned itself through a variety of cycles, credit, interest rate, et cetera. And so all those risk factors were present in Silvergate. And it really isn't, about crypto, except insofar as it follows from the observation that crypto is an extremely volatile business. It's the volatility and the liquidity risk management implications of that when you're dealing with a business where you don't have a long track record and therefore your outflow assumptions are always going to be wrong that we're facing here. So it really isn't. What happened here is about crypto, but really isn't about crypto. It's about asset liability management and what the appropriate risk procedures should be in a bank and how much capital should be placed against this. One of the odd things about Silvergate is its risk-based capital during this whole period didn't change. It actually increased because the risk-based capital standards treat these securities as zero risk. And they're thinking about risk of repayment, credit risk, not asset liability management, liquidity risk. So it was really odd. So they burned half their capital and their actual capital, their leverage capital, and their risk-based capital actually increased a little.
That's a little bit of a criticism of maybe not directly, intentionally of the risk-based capital system, but it's a fair point, though. And I will tell you that we're hearing from the regulatory community a little bit that as you're seeing banks see tangible common equity, TCE, get really hit with bond portfolios being so underwater, maybe a little bit stretched, that's coming up in exams, and that markers, whether or not it's something that could push them to a threshold to where there would be regulatory action. We're hearing the idea that, levered banks with relatively high loan to deposit ratios and maybe a TCE even as high as 5, not say that's really high, but it's also not very, very low. That's where they're starting to kick the tires a little bit.
5% seems like where it goes beyond being a worrisome problem to a problem that needs actual action by the regulators.
So you think that's definitely prudent, and perhaps this is just another reminder.
Right. And so, liquidity risk is always there. We have a generation of bankers who've never seen rising interest rates. They don't understand deposit volatility as well as they should. Deposit betas they're learning all about it. But, it's been a long time since rates went up. And, people who are ancient and hoary and gray-bearded like myself have seen this many times, but a whole generation of bankers really haven't.
Well, and to that point, the 16 to 19 cycle, it almost doesn't, it's not really instructive for this, because it was just such a slow pace of tightening, terminal rate being so much slower, and just not really seeing shifts in liquidity at all. The calls just kind of went up. You almost have to go back to like the 90s if you're really going to look at anything.
See, and there are plenty of examples there. And, to your point earlier about broker deposits and volatility of funding that way, we learned a lot of these lessons, and unfortunately we keep having to relearn them. But the difference here is, and I want to defend Silvergate a little bit. I don't think anybody could have expected exactly what happened, because nobody had ever known that this would happen. Now, to take them to task, they shouldn't by any means have been so concentrated in any one industry and in any one liquidity risk. It's just imprudent banking practice.
Well, and I want to pick up on that, because that is something that really strikes me. And while I wasn't covering the space in the 90s, I've tried to go back and look at that to learn about the space. But even in the GFC, I think concentration was a huge lesson. I mean, more so on the asset side, but I could think of banks in Atlanta that the street really respected, and they would say, concentration was our lesson, because even if we felt good about the underwriting, if we were underwriting a piece of real estate and the guy next to us did something stupid, we had a problem. And I kind of think that that's sort of the same kind of risk practice here, but maybe I'm missing something.
No, it is. The weird part about it is, the asset liability management is managed in the treasury function as opposed to the credit risk function, which is focused on assets, on loan assets and other long-term assets. So, it may get a little less attention. And there's always a temptation in asset liability management to boost earnings slightly by taking, what are supposed to be entirely liquid and safe assets and moving them a little further out on the maturity curve and, to generate a little more yield. We've been in a period for 10 or 15 years now where, nobody ever got burned for doing that, right? Well, now they're getting burned pretty badly because, the rate rises have been very rapid and higher than street people were assuming for quite some time. Interestingly, we're seeing a reassessment of some of these banks. I mean, even today, First Republic and PacWest were off very sharply, as well as Silvergate and Silicon Valley Bank. And one would assume it has something to do with the perception of their exposure to interest rates and to increasing deposit betas.
And just that idea of that duration play that I think you were kind of going at. You got paid for taking duration risk for much of the last decade, but now it's kind of we're seeing the risk there.
You bet, and that's an old lesson, but again one that hasn't been taught to anybody in quite some time.
And if I could pick up a little bit on Silicon Valley there, it's one that I remember a little over a year ago, somebody who I know has been in the space a long time saying, just run a screen showing what would happen if you brought their deposits back to pre-pandemic levels and what happens to the bond portfolio. And I remember going back and forth and saying, well, what would drive that? And they said, well, let's assume that there's a spike in interest rates and that bond portfolio is underwater. It's interesting to run that screen. And maybe I'm oversimplifying it, but it kind of seems like that's a little bit of what's come to head, maybe not that dramatic, but that in the face of outflows, you saw a big security sale at a loss here.
Yeah, for sure. No, that's exactly what's happened. This bank, which incidentally, back in the 1990s, back when I was a lawyer, I represented them. I was their corporate lawyer. And so I have a fairly good understanding of their deep past. And it's a cyclical bank because it is so tied to the tech industry, in particular what's happening in Silicon Valley, that during boom cycles, it's essentially servicing startups and the venture capital community. And there is a tremendous amount of money being raised and not being deployed all that quickly. And most of it goes into deposits at Silicon Valley Bank. And so during good times, their deposit portfolio grows very, very significantly. And one of the key strategic challenges they've always had is what to do about that. At various times, they thought of it as, how shall we deploy all these deposits into something other than the tech lending that we're doing, which is it's a very important business, but not that large a business. And so they went through periods back in their early days where they invested in winery loans. They actually had a church lending business at one point. The idea being, we got to deploy all these deposits. But they always found that when the tech cycle turned, those deposits went away pretty fast. And so the current version of Silicon Valley Bank was focused on, just like Silvergate, on the idea that we had to manage this as a liquidity risk, and we would invest in securities, and so that when inevitably the deposits started to roll off, we'd be okay. But again, they radically underestimated how fast this would happen and how large, as you pointed out earlier, their deposit base. I mean, the current cycle that's been going on for the last 10 years was the biggest ever, lasted the longest, and the deposit balances just ballooned. And I should also say that Silicon Valley Bank has been expanding around the world, and so its place as a tech player is no longer just in Silicon Valley, but everywhere else where tech, VC, and startup activity is strong. So the problem, which was always there in the business model, highly cyclical, just became really, really big. And so, what they did here was recognize that in a very a less intense way, they were experiencing what Silvergate experienced, which is deposit outflows and an underwater portfolio. And they decided, because they're a strong player, they could raise equity. They have a relatively diversified business, although very tech focused. So they went out and bit the bullet and sold off all the available for sale securities at a $2 billion loss and raised a bunch of capital. And their hope is they're going to put all this behind them. Their net interest margin will improve because they'll be investing this money at a new rate. And they'll be well prepared for whatever happens in terms of their deposit balances going forward. But they're clearly preparing for an exaggerated version of the cyclical reversal of their deposit balances that they've seen many times before. So making a long story short, your friend was exactly right. That was the risk, and it has always been the risk in this company.
And they're taking the approach now of sort of first loss is best loss, and not to say that they would find themselves in
right. It's an investor relations matter. Now this is all in the rearview mirror. They're going to have a terrible first quarter, but it's all already announced, and people will be focused on what's the earning potential of this going forward. Obviously, there's been a great deal of dilution, so they've reset the starting point. But ideally for them, what will happen is they will, be more stable and more predictable going forward. Understanding that cyclical company, cyclical stock, it needed a correction for sure. It's always been valued not completely on its fundamentals. It's always been valued sort of as an adjunct to the tech valuation booms. So it's not surprising that its valuation has come down quite a bit.
Well, and, I look at them and I don't know, it's a challenging situation, but one of the things that I've kind of learned in this space is that you almost make the most money if you have money when no one else does. So it's kind of like we've been increasingly having this conversation on a more smaller example level of, do you want to grow at this point in the cycle, or at least dial back your growth expectations? And maybe wind back the clock for them, could they have kicked out some of that business and said, maybe we don't want all of it, with the idea that we don't have this situation where maybe we could lose some of it and suddenly have kind of a liquidity rush? I don't know how you think about that, but that's...
And I can tell you that they've thought about it in the past. Again, taking the 30-year perspective on them, at various times they've tried to, back in the day, they tried, when rates were generally higher and there was the alternative, they tried to push a lot of these excess deposits into money market funds that they managed that would stay off balance sheet. This cycle, money market funds didn't exist effectively because they couldn't generate a yield sufficient to support the business. And so there was no alternative because rates were so low. And so it's slightly different from their past experience where they were aware of this and tried to essentially move excess balances into other vehicles for their clients, partly for their clients' benefit and partly to reduce their own risk.
Well, in closing, I kind of want to take sort of the big picture view, maybe of Silvergate, but maybe just the idea of concentration and whether or not we think maybe regulators missed something here. And I don't know if it's fair to say that or not, but I can go back and look at the FDIC's books reviewing various challenges they've had of bank failures, and concentration is one that comes up quite a bit. So as we already talked about, we know this. Are you surprised that an institution was allowed to get sort of that concentrated in any one business?
Yeah, frankly, yes. Part of it is, the reason it's probably happened is bank regulators tend to think in terms of credit risk and credit concentration and somewhat less in this deposit area. Although, as I think 2 weeks ago, in response to Silvergate and potentially what was happening at Silicon Valley Bank, they issued a joint statement, reminding people of the importance of liquidity risk management in a rising rate environment. So it's not like they didn't know about this. The question for me is whether it's ever appropriate to allow a single industry bank to get this large and to have these large deposit concentrations. And I would say, the lesson here is no, it's not good ever to have a bank, or I shouldn't say it's not good ever, but maybe that bank should have 30% capital instead of 10% capital, right? If it's so concentrated. So something wasn't working in terms of the risk management oversight at the regulators, just as it was not working in the risk management oversight within the company. So I think it's a useful reminder. Luckily, it's a completely non-systemic bank, so no hurt to the general system, and a very strong reminder that risk comes in the form of both liabilities and assets, and that liability risk management can take down your bank as easily as credit errors. So I think it's going to be good in the long term for focusing people on this, and it's a lesson to be learned by folks who want to do very specialty focused banks. It may not be that you shouldn't do that business, but it may be that you need to do it in a way that protects the banking system, and that may mean more capital or more stringent liquidity management, where you're not really even investing in securities, you're investing in more or less in cash. That'll obviously affect your profitability quite a bit. And so it may mean that it's impractical to do that business in a regulated bank, and that may well be, the outcome of all this certainly for the crypto industry.
Thank you so much. Really appreciate you coming on and sharing your thoughts.
Okay, it was great to talk to you, Nathan, and I appreciate your asking me to join you.